Hi, this is Stephen here from Share Navigator, and today I'm going to talk about Citigroup. And I'm going to talk about two ways you could invest into Citigroup. One is buying the stock, and the other one is buying a call option. And I'm going to talk about the pros and cons of each strategy. And with Citigroup, it's a stock we like. It's got a $70 target price. It's currently at about $52 and it's paying a 4% dividend. So if we were to simply go and buy the stock and over the next 2 years it reaches our target price, we would make a return on investment of about 39%. And we're getting that 4% dividend there as well. So there's a good reason there to own Citigroup. It's a stock we like. We think the fundamentals are strong and we think into the future it's going to do quite well. But is there a less risky way of participating in Citigroup? And the answer is yes to that. And we're going to explain a little bit about call options to you today. So if you're totally new to options, don't worry. We're going to keep this jargon free as best we can. And we're going to just simplify it. But if you would like to know more and get more detail and do a course on it, you can go to our website, sharenavigator.com. We have a free course on call options, so you can go out and find more detail. But let's talk a little bit about Citigroup and how we could actually participate. So we talked about we could go and buy 100 shares of Citigroup, invest about $5,000 into it, and over the next 2 years we reckon we could get a return of about 39 to 40%. But I'm going to share a strategy with you now which could actually reduce your risk by 80%. So you could invest basically a fifth of the capital, get a return on investment of about 117% on that capital, and that's by purchasing a $50 call option. So what is a call option? Well, a call option is a derivative of the stock and it trades on exchange. And it's really important that you understand that on exchange means that there's buy and sell prices. In other words, you can buy a call option and sell a call option anytime that the market is open. And in our case, the exchange is the CBOE, which stands for the Chicago Board of Options Exchange. And options are bought and sold like stocks. They have buy and they have sell prices. There's two types of options. There's calls and there's puts. We're going to focus on call options for today. And a call option simply gives the owner of the option the right, but not the obligation to buy a stock, in our case it's Citigroup, at a pre-agreed price, which is known as the strike price, by some agreed date in the future, which is known as the expiry date. So we're going to simplify that with a real life example now in a moment. And there's a cost to buying this call option. So let's use the Citigroup example. We went and we looked at the prices out to January 2022. So that would give us over 500 days before this options would expire. And we seen that we could actually go in and buy the $50 call option. So we could buy the right to buy Citigroup anytime between now and January 2022 for $50. And the cost to us for buying that call option is $9.21 per share. So if we were to take control of 100 shares, it would cost us a total of $921. Now, if we actually reached our target of $70 on Citigroup between now and January 2022, we would make a profit of at least $10.79 per share, which is a return on investment of 117%. So the return is a lot higher and the capital outlay is a lot lower. But there is pros and cons to this strategy. And let's talk a little bit about that. So let's talk about the big pro first for buying a call option versus buying the stock. And that's your capital outlay. So with the stock, for controlling 100 shares of stock, it was costing us 100 times $51.73. And that's $5,173. But taking control of 100 shares by buying the call option, all that cost us was $921. So it was only a fifth of the cost of the long stock. So you could have 80% of your capital working somewhere else for you. So that's the big benefit of buying the call option. However, the downside is your break even is higher. The stock has to move a bit more in order to start making profit with your call option, assuming we're now in January 2022, than it is for buying the stock. And the break even is $8 higher, so it is quite substantial. Your profit potential on a per share basis is also lower with the call option. So with the stock, if we hit $70, we would make a profit on a per share basis of $18.27, whereas with the call option, it's only $10.79. Now, that can be a little bit misleading because don't forget you only invested $921 in your call option. But with the long stock, you actually invested over $5,000. So your return on investment, and this is another big benefit of the call option, is a lot higher. It's at 117% versus only 39% for the long stock. And when I say only 39, it's a quite substantial return on investment. But the real pro of this buying this call option, it's the lowest cost of the trade, it's the higher return on investment, and therefore you have lower risk. The downside is you have a much higher break-even price and you don't get paid a dividend, whereas you do get paid a dividend with the stock. And the dividend is substantial, it's actually 4%. The downside of owning the stock, though, is if the Citigroup doesn't work out and there's bad news about it and the share price goes down substantially, you stand to lose more by owning the stock than you would the call option. So as you can see, there's pros and cons to both strategies, and it's going to be different for each investor. Some longer term investors who like the idea of getting that 4% dividend will just like to buy the stock and do nothing. Other investors who may want to preserve their capital, use their capital for other things, can get control of that same 100 shares for a fifth of the price basically. And if the stock goes to the target price that we suggested, your return on investment is going to be a lot higher. So a higher return on investment for less risk. The downside is the share price has to move a bit more because that break-even price is higher. So what would you choose? Well, that will boil down to what type of investor you're going to be. And everybody is different. There's no right or wrong answer to this. But what's really important about this podcast is that you understand that there is different ways to participate in a stock. It's not just about buying the stock and holding it. You can do and invest in less risky ways, and it might be the right way for you. So I would encourage you to investigate more about options, how you can use them to your advantage, how you can use them to reduce risk in your portfolio. This is just one simple strategy. Over the next number of weeks and months, we hope to introduce more strategies to you that will demonstrate to you that using options in a very smart way, you can reduce the risk in your portfolio going forward. So I'd encourage you to go to our website, sharenavigator.com. Sign up for our free membership plan. You'll get access to all the courses on options for free, and it's a great way for you to learn about options. You'll also be able to participate with other members who are actively trading the options market, and you can learn a little bit from each other as well. Okay, I hope you enjoyed the podcast. You just learned how to reduce risk in your portfolio by buying call options. We will be sharing more risk reduction option strategies with you over the next weeks and months, so please remember to tune in and follow us on our podcast. Okay, this is Stephen from Share Navigator. Thanks and bye for now.